Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Welcome back to the Australian Retirement Podcast, coming to your ears every Thursday. A pleasure to have Drew Meredith here. Mate, Happy New Year.
I know, a little bit tired and I'd say dusty this morning, but we are recording slightly in advance. But I think it's an incredibly important time to be thinking about retirement. A lot of new listeners tend to come and join us, join podcasts, join YouTube this time of year. So welcome. And as you'll probably find out, that James and I love all things retirement. So it's good to be here.
Well, we have an action-packed session today. We have 20 things that pre-retirees can do to smash 2025. Now,
we're going to keep it short.
Yeah, this is not going to be a 3-hour podcast, so we're going to absolutely drill through this. I've got a stopwatch here. I'm holding you accountable, as I will myself, of course. And we've also got a pretty cool offer at the end for some for two listeners to get some free financial advice with us, which is something that we'll unpack at the end. But let's rock and roll.
Super exciting.
This is we're going to run this to a T. So if I may, I'm going to get started because the first one is a really obvious point that you were good enough to put forward, which is one of the most important things you can do is, please, if you haven't already, set up My Gov. Set it up. Link the ATO. Link to your ATO portal. It is incredible.
Link to everything. Link to Centrelink. Link to everything they can possibly link in there, and it can be hard.
Yeah, it's definitely one of those holiday type things to do, isn't it? Because it's not always easy, but you will need to get it done, and the benefits of getting it done are significant in terms of the visibility you have over your own finances. It's actually a pretty good portal. It's pretty intuitive, and once you've got it done, it's done, right?
Yeah, I mean, it's one of those strange things that you'd expect an advisor could just log into some system and get access to it, or your accountant. But in most cases, you actually have to do this yourself. It looks at your total super balance. It looks at your contributions caps. It can basically tell you everything you need in one spot. And yes, there's a few bugs when you're trying to set it up. Your name has to be written appropriately. But this is, maybe it sounds boring, but this is the number one thing. If you haven't done this, you should be doing it.
Let's keep moving. You want to kick number 2?
I think this time of year, a lot of conversations come up with family and friends, good and bad, as can be the case. And there's a lot of time for reflection. So this time, but it's also a time where if you're in the lead up to retirement, you actually may have some spare time compared to other periods. It can be incredibly difficult with our busy lives to actually sit down and talk about our future and our plans. So the second one is to sit down with your partner, or if you're alone, sit down yourself and really dig down and think about what your plans are in the lead up to retirement. Start asking those questions. When do you want to retire? And then we'll lead on to a couple of other ones that I won't sneak forward here. When do you want to retire? What's your savings like? Just take stock of everything and have that conversation.
Mm-hmm. Yeah, that still image snap of where you're at.
Yeah.
A lot of people, especially if you're going this alone, if you don't have a financial advisor that you're meeting with at a regular cadence and you know where you are, if you don't have that relationship, it really is important that you do an annual review anyway.
Don't put your head in the sand.
Do it yourself. Yeah, that's right. And make sure you understand where you're going, you understand where you're headed, and incredibly beneficial. Let's keep moving. We're going to go to number 3, and that is review your asset composition. 2024 was a huge year for assets, right?
Massive, and particularly global shares, like the standout by far, probably for the last 2 or 3 years. And I mean, this one's incredibly important because it might feel good to let your winners run. And if, Tesla has doubled, in getting a bit specific, but Tesla's doubled between November and the end of the year. And Tesla is a large part of every benchmark and index. So what happens when different parts of your portfolio perform better than others is that they grow as a portion of your portfolio, which means you're taking more risk by maintaining them at that level. So this is always about, we suggest quarterly, but if you're doing it yourself, at least annually. Look at the composition. What asset classes are you exposed to? Where does that sit in terms of your risk profile? And if you've seen advice, you'll understand that a bit more. But making sure you're not taking unwanted risks or overexposing yourself to a couple of companies or sectors.
Yeah. But as a side note, I always find the behavioural element of share prices interesting when you're sitting down with people for the first time. You might have, for example, Tesla. Yeah. Tesla fell in value significantly a couple of years ago, and I remember having conversations with people who'd come in that own Tesla, saying, "Oh, look, it's fallen in value, but I don't want to sell it right now because it's not worth what it true like it's not worth its true value because it had fallen, so they're anchored to that lower price. But then curiously, when it goes on a tear and it doubles in value, everyone says, well, now it's rightfully priced where it should be.
It's still not worth it. It's still too cheap to sell.
Correct. Yeah. And so I mean, I speak to the benefit of getting some, whether it's advice or doing your own research and better understanding these positions, but make no mistake, there are overvalued positions in the market right now, some significantly overvalued positions. And if your asset position is going to, if you haven't done anything over the last 12 months, you've likely got more growth assets than you do defensive assets now, just because growth has grown so quickly over the last 12 months. So it's definitely time to review that and make sure that you're not overexposed to either a specific stock or overexposed just more broadly to, for example, international shares or domestic shares.
And I see concentration, which is what you're talking about, as one of the biggest risks to a successful and kind of consistent, sustainable retirement income. That kind of leads on to my second, or our fourth, which is, and this is quite popular in a lot of investment books, but if you're managing money yourself, if you're investing, if you've got multiple accounts, put all your investments on a page, then turn the page over, go blank, and write down the investments that you would actually buy again today if you had the opportunity. It kind of gives you this ability, which can be difficult when it's your own money, to be objective over the investments that you hold. And this is both companies that have done well and companies that have done poorly. So try to take a fresh page, a fresh approach to every asset you own. It doesn't have to be stocks, and ETFs can be property as well. And just rethink whether you would still hold that again in 2025, and if that fits your long-term and your retirement strategy.
What a great exercise. Yeah.
You can do it on Excel. You don't have to use physical paper.
No. We want a proper piece of paper and parchment.
Yes. And a fountain pen.
All right, let's move across. We're going to go to contributions. If you're a pre-retiree, we've spoken again and again and again about how valuable the superannuation system is in the lead up to retirement. It's more tax effective. The contributions that go in are much more tax effective. And if you're not utilizing it, or if you don't have to rephrase it, if you don't have a damn good reason for not utilizing it to the absolute maximum, then you should be. And so the one that stands out to me is to understand what your concessional contributions are. Now, as a reminder, they're those contributions that you put into superannuation that you can claim a tax deduction for. The cap for this financial year is $30,000. And so that includes your employer contribution. So if you're, for simplicity, earning $100,000, then $11,500 is of that cap is being eaten up by your employer, hopefully paying your super contributions on time. But check your contributions, understand what's left in that cap. Critically, also that option for catch-up contributions, if maybe you haven't been maximizing the cap for the last few years and your super balance was below $500,000 as of 1 July in the beginning of whichever financial year you're in, which of course right now would be 1st of July 2024. So incidentally, all this information is available where? My Gov. So if you have
that's why we live with that one.
That's right. Then this process is super easy, and it can actually become a lot more accurate in reality if you've got multiple super funds, because that can create some confusion around what you think your caps are, or what your space is versus what it actually is. Yeah,
exactly. And then a little trick around this as well is if you're making extra concessional contributions into a fund, you're actually going to be taxed. Contributions tax when that goes into a fund, which can be surprising for some people when they lodge if it's an SMSF tax return later on. Sticking with contributions, so I'm going to flip this one and say just check. You probably lodged your FY24 tax returns by now. Check if your income was between $45,400 and $60,400.
That's very specific.
Very specific.
Why those numbers?
If your income is between those amounts, you will likely be eligible for the government co-contribution. And this is money. It's free money. Free money. Money for jam, free money, whatever you want to call it. And basically, if your income is between those, if it's below the lower threshold, that's fine too. Obviously, it can't be above the $60,000 threshold. But as soon as if you make a $1,000 non-concessional, so a not tax-deductible contribution, you get $500 from the government.
50% return.
Exactly. Guaranteed. Never advisors never say guaranteed.
Okay. Yeah. Well done. And then let's lead on with that one, because while we're talking about non-concessional contributions. So many people are focused on, of course, concessional contributions because you're getting that tax deduction. But of course, you can see how there's that non-concessional that's available where, bam, immediately you're getting a 50% return on investment, which is huge. But there is another wonderful way to get an immediate return on a non-concessional contribution, and that's via what we call a spouse contribution. So if you have a spouse and their income is below $37,000 for that financial year, then you can contribute up to $3,000 and get what's called an 18%, or you get an 18% tax offset.
Yep.
Now, offsets are better than deductions. Deductions will reduce your taxable income and then it'll go through the washing machine of how much tax do you pay. An offset sits at the other end of that washing machine, and however much tax you pay, it just reduces by that, it takes off that. So it's truly tax saved dollar for dollar.
But not free money.
No, it's tax saved dollar for dollar. It's not free money. But the benefit here, of course, is that if your spouse's income is below $37,000, let's assume that you're paying some tax through income or whatever means. In that scenario, then you are going to be getting 18% of that back, up to $3,000, as we said. So the maximum is 18% of $3,000, $540 tax offset. So this is another immediate cash return. Makes heaps of sense. One of the great things about this too, the government co-contribution, that's $1,000 into the super fund, and they will pay the $500 into the super fund.
Yep.
But this goes into your pocket because it's money coming back straight off your tax. So you're putting $3,000 into your spouse's superannuation, and when you do your tax return, you're $540 better off in your own pocket.
The next one, we're getting a bit deeper into financial position and strategy and looking at what the lead up to retirement looks like. So this is review your life insurance. And there's a couple of reasons for this. You might have, if you have multiple super funds, you may have multiple types of cover. If you have an SMSF and an industry fund, if you have an industry fund, another industry fund, making sure like you're not double covered, and probably generally and this would be an area where you should seek advice. But understanding whether you have enough cover, or on the other side, do you have too much cover? That's important because as you get closer to 60, so pre-retirement, you're probably talking 50 plus. As you get closer to 60, cover gets more expensive, takes up more of your cash flow, leaves you less to save. And in some cases, if you have significant assets, you may have the ability to self-insure.
Yeah.
And then you can also see your cover reduce as you age, so you're paying more and getting less. And this is and unless you really look closely at your statements, you're not always 100% sure of what's happening.
Yeah, agreed. Yeah, the older days of industry superannuation funds having lower cost insurance than you could get in retail, those days have changed. Simply because, of course, at a certain point in time, they realize they probably need to reprice their books, and when they've done that, those premiums have gone up.
Easier to get maybe, but
without a doubt,
not as cost
depending on how much you need. So it's very important to be aware that as your costs are getting higher and higher, your insurance costs may be getting higher as you age. It becomes more valuable to do some research and get some advice and see if maybe I can get these premiums lower if I need them.
Yep.
But as you astutely pointed out before, of course, hopefully you're in a situation as a pre-retiree where your net assets are growing. The kids have finished school, so you don't have to think about education funding. Maybe your expenses are a little bit lower. Maybe you've cleared the mortgage now. So those events that are happening for you as a pre-retiree are probably creating a lower need for insurance. So being overinsured as you approach retirement is just a huge money pitfall, money hole. So knowing what you need and then having cover that's not only appropriately addresses that and that only, but also having a premium which is comparative.
Yeah, for sure. And a big one here is, I always say, seek advice before cancelling or changing insurance policy. And one thing in financial advice is there are insurance-only advisors that can help. So without needing look at your entire situation, not suggesting that's what you should do, but if it is insurance only, you can definitely get advice just on that.
Agreed. And to add to that, Rask has a great relationship with an insurance only advisor. So again, if you do want that, Phil Thompson from Sky is your man. They're a great team, and I'm sure they could look after you there.
Rolling with insurance and continue on that stream is, I think it seems like one of the biggest and fastest growing expenses we have these days, which
private
is
health cover.
Private health insurance.
Mm-hmm. This is huge. And luckily, in only a few weeks' time, we've got a couple of episodes coming from Dr. Stephen Liu specifically dialing into health cover because for pre-retirees and indeed retirees, private health cover is it's a huge expense.
Definitely.
In a lot of cases, a lot of people see it as a necessity, and like we can totally understand why we take that view. But having said that, the offer of what private health insurer is and the different options that are available, as your costs get higher and higher, which invariably is going to happen as you approach retirement, again, we really need to make sure that we're getting the best bang for buck, i.e. this particular policy that we hold is the very best policy for us.
Not too many extras.
We've got the features that we need and nothing else.
Yeah.
And so again, there's a podcast coming pretty shortly on the Australian Retirement Podcast, which is going to really dial into this a lot more. But regardless, reviewing your private health, don't get complacent with this and just let it roll over for the 8th or the 9th or the 10th year or more.
An 18% premium increase. Yeah. The next one, and we're getting more into investment specifics and cash specifics. So this seems like a no-brainer, but it seems to happen and grow all the time. And that's checking out, finding your super funds and consolidating, ensuring you've consolidated, or if it's appropriate, those super funds into one. The highest level of fees when you have multiple superannuation funds come on the lowest balances, like a $0 to $250,000 balance has the highest percentage fee, regardless of whether you're in an industry fund, a platform, or anywhere, and an SMSF. So if you have multiple funds and they're at different levels, you're almost always going to see fee savings by consolidating them into one. Mm-hmm. Naturally, that comes with a disclaimer. Check your insurance, check your investment approach, check the restrictions before you look at doing that. But anywhere, I think this is the key here, is anywhere you can either save money or get a bit of free money is central to accelerating that retirement.
No doubt. Yeah, it's staggering how many people we encounter that come in and have 2, 3, 4 super funds, and it's just that situation of saying, yeah, I know I should do something. I know I've needed to do something about that for a little while, but it's always just been one of those important, not urgent things that sat on the sidelines. So in early 2025, if we're talking about having the best financial year that you can have, then it's time to address that.
Yeah, for sure.
All right, let's have a chat to your mortgage broker. That is definitely something to better understand here, because we're seeing right now that the gap between a really good home loan rate, investment loan rate, versus the best and the worst, we're seeing that gap is
increasing
very
so much.
wide.
Yeah. I think there's incredible opportunity here, and particularly I think as interest rates have gone up and banks have become less competitive, less price competitive, they're all trying to maximize their profits in what's a difficult period. That the gap, I've seen gaps of like 1.5% to 2% between loan facilities. So call your mortgage broker. Don't always call your bank, but inform yourself by doing some research. And there's I think there's lots of mortgage brokers around that work with multiple banks and multiple lenders rather than being tied to 1, 2, or 3. And it's like anything. If you have an investment property, if you're still paying a mortgage, this can significantly change your after-tax income and what you're able to put away for retirement.
Yeah, absolutely. Yeah, I mean, we were like using the term free money before. This isn't quite free money. You got to do a bit of work for it. But really, in terms of the return on investment you can get from really tightening your rate and knowing that you're going to have a home loan no matter what, your investment loans no matter what, if you've got them. Yeah, this is a big one. But it probably ties in, if I may, to the next one down here, which is around checking your bank accounts in general, making sure that you're getting the best interest rate. Because similarly, the difference between the best and worst is enormous. Yeah. If we go back 2021 or thereabouts, really low interest rate environments, the very best savings account you could get would be 1.25%, somewhere in that sort of zone. And the worst, of course, was 0. And so the gap was pretty tight. Yeah. It breaks my heart to have people come in who've got big amounts of money that are sitting in a
1%.
Or not even, in a smart access account, for example, the earnings rate is 0.
Usually it's because it's an historical account or it's been around forever.
Yeah, that's right. Yeah, and so the gap now, the best savings accounts are giving you 5.5% or thereabouts, and the worst are still 0. Yeah. And so the gap is so much larger. Again, I mean, ideally you'd have all of your money in offset accounts against loans.
For principal mortgage,
but if that facility is not available, perhaps you've cleared your debts, please, it is very important to have your money in the right accounts, because that 2 or 3%, even on $30,000 or thereabouts, 3%, that's $1,000 a year just from having the money in the right bank account.
And this doesn't mean you need to change and open and close bank accounts and do all the admin around it. Part of it is also making sure that if you have opened accounts, that what the interest rate you were getting wasn't just a bonus rate and it's now disappeared, because that is something else that happens. So don't suggest changing all the time, but just make sure what you're getting is competitive, and it's at least around the RBA cash rate, which is still 4.35%. This one could be a bit controversial. I've got a pretty specific policy on this, but in my experience, dividend reinvestment plans aren't necessarily conducive to success and a consistent diversified retirement. And part of this comes back to number 3, which is review your asset position. What the problem with dividend reinvestment plans, particularly with ETFs and global share or just growth investments, is if they're performing incredibly well and you're reinvesting all those distributions, that portion of the portfolio continues to increase quite significantly. And that's without touching on the significantly more complicated tax calculations that you have if you do DRPs for 25 years. But generally, my approach and my advice, obviously general only, is take the money in cash and take the opportunity to have structure around where you're deploying that cash. Do you need it for cash flow, or can you put it in another part of your portfolio that's better valued or underweight compared to one part? Yeah.
It's interesting you say this, because I've recently been having this conversation with my team, the idea that for some people, if you're either completely inactive, not seeking advice, like that sort of scenario, then a DRP can make sense because it's better than the money just sitting there on the sidelines and going back to cash and you're not doing anything. But if you are being proactive, then why wouldn't you take the opportunity to get the money in cash and make a conscious choice as to whether or not it's better to reinvest? Yeah. If sometimes DRPs work remarkably well. Yeah. Of course, they've been bloody good in CBA for some time with where it is, but of course, you're going to lose that bet and everything will be better. But equally, if you had hypothetically, or if you'd reinvested in BHP all the while, then you would not have got anywhere near the returns than if you'd put the money elsewhere over the last, say, 15 to 20 years. So yeah, it comes back to that piece of paper idea, doesn't it? Like, do I want to invest in this?
Because you make a decision to buy more every time.
Yeah.
Or you're making a decision, but if it's a forced decision. So it's taking that discretion. And I'm really excited by this one.
No, you're not.
Well, it gave me some good news. So what have we got for this one? It's
I'm not following you.
You're going to pass it to me. All right. So one thing that I've been reading a few books at the moment, and there's a lot, and every time there's comments on YouTube, on social media that talk about life expectancy. So one of the big things I'm telling all clients and anyone pre-retirement or even in retirement is go and do a life expectancy calculator.
Even just like people you see on the street, baristas.
Anyone, do a life expectancy. 50% chance you'll be over. Like I think mine was 50% chance I'll live past 95.
Oh, good on you.
50%. I'll take that. That's a good number. But this is not just because what the biggest issues we have, one of the biggest issues we have is that our life expectancy tables are very backward looking and not necessarily looking towards the future. And one of the most important things you can do when you're heading into retirement is actually have an idea of how long you're going to be in retirement for, which can help you have the confidence to make real long-term decisions rather than focusing on the short term. So do a life expectancy calculator. The Australian Bureau of Statistics website says if you were born this year, you're expected to live to 81 years of age. But number of calculators will tell you that if you're 65 this year, you're more likely to reach I think you've got a 50% chance of living beyond 85.
Yeah.
Which is a bit of a stark difference there. 4 years on 80 is 5%.
Correct. Yeah. And just to be clear, one of the reasons for that, or the predominant reason, is that if you're thinking about life expectancy from being born today, for instance, well, then you've got all of the things that can happen as a child and then teenager and young adult, etc. Whereas if you're a 65-year-old, you've already passed the first 65 years. You've already cleared all those hurdles. Yeah. So naturally, your life expectancy is going to be a bit later. I love this one too, the life expectancy calculator, because I agree that it helps people to have a longer lens on their retirement and what they want, and there's a lot to be said for that.
Yeah.
But I also like the little reminder that, hey, we're actually not here forever.
Yeah.
And my experience is that if you are, like we talk about pre-retirees, and we might be thinking about people that are, for example, 50s or thereabouts. But there are some pre-retirees that might be listening to this that are currently 68 or 72.
Yeah. And still working.
And still working. Yeah. And my experience is that going through that exercise can really enlighten you to the reality that, okay, well, I'm not here forever, and I want to make sure that I get the most out of my years.
Yep.
Of course, it's a confronting message, but I'd rather people have that message and then act on it.
It's cool. It's all about that confidence and planning, and that probably comes into your next tip for 2025.
It certainly does, which is input your numbers into a retirement calculator. Now, 10 years ago, these were hard to find.
Yeah.
They are not hard to find anymore.
Yeah.
They are absolutely everywhere. They're very easy to use, and practically you can understand that if I intend to retire at this point, we talked before about having a clear plan or a clearer plan around what you want to do. Well, punch your numbers in, punch in your super balance and your income and when you intend to retire, and it will pretty comfortably say, hey, there's a reasonable likelihood that you can self-fund or there is a shortfall. Now, if you want really advanced stuff, then you'll naturally need to go and get some advice. But just indicatively knowing that I'm on track or, okay, I've got a lot to do, I think there's a lot to be said for that.
Yeah, there's some really good tools for that. And I think, let's stick with calculators.
Yeah.
If we're going back to talking to your mortgage broker, well, the first step you can do before doing that is going to use a mortgage repayment calculator, looking at comparing what your current mortgage payments are and potentially using the comparative rates that are around in the market to have a look at what the impact could be, or changing your mortgage, or putting more, increasing the regularity of your repayments in this 10-year in this pre-retirement period. So, it's very much just maybe it's grab a glass of wine or a lemon lime and bitters, whatever it happens to be. You don't want to put anyone offside, and just go do one calculator at a time though, and just see what the outcomes are. Sometimes we kind of, too often, I think for a lack of confidence, we don't go out and play with these calculators and look at what the impact might be, but it can be significant. I think that's a key one, particularly around mortgages. With 5 years ago when interest rates were, or 3 years ago when interest rates were near zero, it wasn't. It didn't really matter as much. And now, repaying your mortgage or increasing the regularity of your repayments can be massively impactful.
Yeah, agreed. And just to add to that, if there are a lot of mortgage repayment calculators that are available online. So the most traditional one that you're going to find is the one where you can enter in, I want to borrow this much, and it gives you that extrapolation of how much interest you'll pay and things. But when I'm trying to find a good one here, I would typically type into Dr. Google mortgage repayment calculator early repayments, or mortgage repayment calculator lump sum payment.
Yeah.
And those calculators allow you to, so they'll model out, here's what your mortgage is going to look like currently, and then they'll allow you to say, what about if I add an extra
$5,000?
Yeah, $5,000 a quarter or something along those lines. What about if I put
how much interest you
right
save?
now?
And that's super powerful.
Yeah, and you see that curve sharpening and ultimately, which is resulting in less years of you being you having a mortgage over your property.
And I think we're pivoting back to free money here.
Oh, yeah. So, well, kind of.
Similar.
It's your money. Yeah. So search for lost super is the first one, but also we've got linked to this search for lost money. Now, there's a lost super one. Hopefully most people know about. Again, the easiest way to do this, if you have followed point number one, you've set up your My Gov account, you can go to through the ATO link, you can go to your superannuation balances and you'll say, oh, hang on a second, I didn't realize that there was another super fund here with, $400 or $500 or $500 or $7,000 in there that I would like to consolidate and get this done. You might not be getting any correspondence about that lost super either, because the reason it's lost is because you moved and so they didn't have your mailing address, and so 2 pieces of return to sender mail came and you got pushed into that lost super bucket. But you definitely want to make sure that you've not only consolidated it, but you know where all of your super is.
Yeah, and the extension of that is you can also lose money. Money can be lost in the system for reasons like a change of address if you held shares directly, if you inherited shares, they were never transferred properly. Can be any number of things. And in a lot of cases, or in most cases, the institution will hold on to that cash for a very long period of time, or it will be passed to a state revenue office. So the other one is searching for lost money and lost dividends. And you could find this one I'd probably call free money.
Yeah.
And it's simple as if you're in one of the states, you go to the state revenue office, but you can also go via the Money Smart website where you can do a broader search of all lost money. I'm not saying call every institution that you've ever met and find out if they got any money, but to do the main sources and see if there's anything there.
I'm not sure if you remember when this originally around about 10 years ago with this State Revenue Office lost money tool, it became just really easy to navigate. And so we were just punching in our clients' numbers to just understand if anyone had lost money. And it just felt amazing because you were calling people and saying, hey, did you realize you got $17,000 that's in there? They said, whoa, can I get that? Absolutely. There's a few more steps now to make sure that people's confidentiality is better respected, and that's a good improvement. But it really is very simple to go onto these sites, like again Victoria State Revenue Office, to log in and enter your name and some basic details, and it will tell you.
Yes, you don't have to pay someone to do that.
Yeah,
that's one of the big things.
It's free, it's available, and getting the money back is similarly free and easily available.
And this one, and it probably can a little bit concerningly that there's stats going around that show a number of people over 65 haven't commenced pensions from their superannuation accounts. And there's very few cases where you're over 65, 60 perhaps, but over 65, where it wouldn't be beneficial to have commenced an account-based pension or an income stream from your superannuation fund, whether it's an industry fund, a self-managed super fund, or a corporate super plan. So it's go check if you're over 65, look at getting some advice and looking at commencing that pension. If you're over 60 and you've ceased work at some point after turning 60 years of age, also be looking at the same thing. Why? As soon as you commence that pension, all the earnings, all the income, capital gains within that balance up to 1.9 million are tax exempt.
Mm-hmm. Yep,
free
which
money.
Is huge. Yeah, that is free money. Yep, completely agreed. That's a great one. We're on
nearly there.
19. We're humming. Review your estate planning. Most Australians have hopefully got a will in place and perhaps hopefully a power of attorney or something similar. But is it up to date? This is easily one of those things where family circumstances can change, your priorities can change.
Grandchildren, children, houses.
It's definitely suitable to review this if you haven't done that recently. Now, some people might be listening to this saying, oh yeah, a will. I really have to get that done. Yeah. And if you are in that camp, that's totally cool. This is your very gentle but very firm reminder. Yes, you do need to get it done. It's time. It's time for you to get that done. If you want to have the best 2025 that you can, you want to smash your finances, you can't get to the end of 2025 and not have this resolved. So it's time.
And the last one, this isn't supposed to be a sell, but this started off as being organise a meeting with your accountant. There's been a lot of windfalls. There's been incredibly strong returns. If you've been investing, if you've got properties, if your interest rates have gone up, all your things can change significantly. And if you've lodged your FY24 tax return, well, it's actually, I think, a key with working with accountants is making sure you're not just waiting until the tax return after the financial year to prepare your tax return. It's about planning ahead. So organise a meeting with your accountant, or if you have a financial advisor, organise a meeting with your advisor as well. Find out, is there anything you could be doing proactively? Make sure you're reviewing everything, any changes that you could take advantage of. And part of that, I'm sure, take your My Gov with you and take your screenshots as we go back to number one, and just make this part of your yearly process. Make sure you're catching up with those professionals, because that's how you have the ability to look forward rather than being controlled by the past and the previous financial year.
Agreed. Importantly, accountants don't take holidays ever. So if January, they'd love to meet with you. Early Jan, 2nd, 3rd of Jan, just roll in with all of your things. We're sure that they'll accommodate.
And you got an exciting offer to close out, to open up 2025.
Yeah. We have absolutely loved the opportunity throughout 2024 to have the opportunity to be talking to all of you, and we've had some wonderful feedback from many of you. Some great, some very constructive, and where it's really meant a lot to get so many questions and so much engagement from all of you. Thank you. And as a result, we would like to table an offer to all of you which is that both Drew and I are going to give a financial plan to one of our listeners each. So if you're interested in that, then please, there's a link in the show notes that you can click on, and that will take you through to give you the details. But we really want to pay it forward. And so for two of you, or whether it's couples or individuals, where we'd like to go through the process and give you some high quality advice that can help you to have the best 2025 possible.
And that's an average value of somewhere between $5,000
to 50.
$5,000 and $10,000, or $5,000 and $15,000, probably more specifically, depending on the complexity that you're getting by submitting to this process.
So get on board. We would absolutely love to help a couple of you even more than we already are. That's the game for us. We've managed to keep this to pretty good time. So thank you to everyone. Welcome again to 2025, because this is going to be a huge year for your finances, and we can't wait to take that journey with you. We'll still be recording. We'll still have that content out every Thursday, and really pumped to have a huge year. Thank you, everyone.
Good to see you.
Ciao.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.